Good day, everyone, and welcome to this chapter's report, Risk and Rates of Return. Today, we're going to discuss certain terms found in this chapter, answer a problem together, and apply our lessons to real life. Today, we're going to talk about risks. Risk is the chance that some unfavorable event will occur. There are two types of risk: standalone risk and portfolio risk. First, let's talk about standalone risk. Standalone risk is the risk that an investor will take if he held only one asset. There are 5 statistical measures of standalone risk, and these are probability distributions, expected rate of return, historical rate of return, standard deviation, and coefficient variation. But what are these? Let's begin with probability distributions. This is a list of all possible outcomes or events with the probability assigned to them. It is graphed this way. Take note that the tighter the graph is, the smaller the risk of the investment. Next, we move on to expected rate of return. This is the average of all outcomes, where these outcomes are weighed by the probability that each will occur. It can be computed using this formula. After that is historical rate of return. This is the rate of return earned on an investment. It can be computed using this formula. Next is standard deviation. This is the statistical measure of the variability of a set of observations. It can be computed using this formula. Lastly, we have coefficient variation. This is the standardized measure of the per unit of return. This can be computed using this formula. So how do we analyze the riskiness of a stock using these formulas? Well, let's say we have two stocks, stock A and stock B, wherein stock A has an expected rate of return of 5%, while stock B has an expected rate of return of 10%. Solely looking at this, we can say that stock A is riskier since we get less return on an investment. But what if we add in standard deviation? Let's say stock A has a standard deviation of 10% and 60% for stock B. Looking only at standard deviation, we can say that stock B is riskier because it has a higher tendency to deviate from actual return. Looking at it together though, considering that stock A is riskier in terms of expected rate of return, while stock B is riskier in terms of standard deviation, how then can we tell which stock is riskier? The answer is through solving coefficient of variation. Using the coefficient variation formula, we will see that the coefficient of variation of stock A is 0.5, while the coefficient of variation of stock B is 0.17. Looking at this, we can see that stock A is riskier because its coefficient of variation is higher. But why do we analyze stocks? This is because investors are risk averse. They dislike risk and require higher rates of return as an inducement to buy riskier securities. Now let's go back to the second type of risk, which is the portfolio risk. Portfolio risk is the total risk of a collection of bonds. It is usually smaller since diversification of stocks lowers risk. However, before we can put together stocks in a portfolio, we must first figure out if a stock has a diversifiable risk or market risk. Diversifiable risk is the risk related to an investment return that can be eliminated through diversification, while market risk, the risk of a general stock market, can decline and cannot be eliminated through diversification. After that, we also have to check the correlation coefficient of 2 or more stocks. This measures the tendency of 2 or more stocks to move together. It can be seen this way. When looking for stocks to put together in a portfolio, you have to look for stocks that are perfectly negatively correlated, since putting together those stocks would lower the risk, while perfectly positively correlated stocks will have the same risks even when put together in a portfolio. Moving on, we see that in evaluating risk of a portfolio stock, we follow the capital asset pricing model, or the CAPM. This is a model based on the proposition that any stock's required rate of return is equal to risk-free rate of return plus a risk premium that reflects only the risk remaining after diversification. It can be solved using this formula. Other things we look at are the relevant risk, which is the risk that remains once a stock is in a diversified portfolio. It is its contribution to the portfolio's market risk. It is measured by the extent to which the stock moves up or down the market. Aside from this, we also look at the beta coefficient of a stock, which is a measure of the tendency of a stock to move with the market. It shows the volatility of a stock relative to the market and indicates how risky a stock is if the stock is held in a well-diversified portfolio. The beta of a portfolio can be calculated using this formula. But how do we know if a portfolio is a good investment or not? First, we look at the market risk premium. This is the additional return over the risk-free rate needed to compensate investors for assuming an average amount of risk. After that, we also look at the security market line. This is an equation that shows the relationship between risk as measured by beta and the required rates of return on individual securities. It can be solved using this formula. Let's say we have the following example. Assuming that risk-free rate is 8% and the market premium is 15%, and stock A has a beta of 1.3. Using the SML formula, we can derive the following, and then we will get a required rate of return of 17.10%. Aside from that, assume we have a stock B with a beta of 1 and a stock C with a beta of 0.89. Using the SML formula, we can get the required rate return on stock, which is 15% and 14.23% respectively. These can now be graphed this way. SML is affected by many things, including inflation and risk aversion. If inflation moves up, the SML can go up like this. However, if risk aversion changes, the SML can change in this manner. We can relate this lesson on risk to the life of American students who cumulatively owe about $1 trillion in student loan debts. In finishing high school, Doug Brockwell had dreams of going to elite Ivy League schools in New England. But he knew that when it came down to choosing a university, it would depend on the cost. Since he didn't want to incur any debt, his dreams were set aside as he opted for a less prestigious regional private university because they were willing to offer a generous scholarship. He graduated from the university without a single debt. However, after years of studying degrees that eventually didn't get him anywhere, he decided to apply for an MBA degree to further his studies. This resulted to a $10,000 debt. Nevertheless, taking an MBA opened more job opportunities for him, and soon enough he was able to pay all his debt. Relating this to our lesson, we can see that the risks that investors avoid are like the debt that Doug Brockwell also tried to avoid during his college years, while the high return that investors want is the successful career that the students get after finishing their degree. Following what we learned from both Doug's story and also what we learned in this chapter, we can see that sometimes taking more risks is better, since it yields more return. Thank you, and we hope that you enjoyed this chapter's video report.